Before we begin, it's crucial to understand that I am not a financial advisor, a mortgage lender, or an official representative of the Department of Veterans Affairs. This presentation is for educational and informational purposes only. The home loan landscape is complex and regulations can change. You must consult with a qualified, VA-approved lender and a financial professional to review your personal situation before making any home buying decisions. The shocking truth is that less than 15% of the 25 million Americans eligible for a VA home loan have actually used it. Let that sink in. Millions upon millions of veterans, active duty service members, and their families are sitting on what is arguably the most powerful home buying tool in the United States, and they're not using it. Why? It's not because they don't want to own a home. It's because of a fog of misinformation, myths, and gatekeeping that makes the whole process feel confusing, intimidating, and out of reach. Someone you know, maybe a well-meaning relative or a real estate agent who just doesn't know better, told you, "Oh, VA loans are a nightmare." Or, "You'll never get your offer accepted with one of those." And the biggest lie of all, that you aren't even eligible. Well, today we cut through that fog. By the end of this video, you are going to understand the core requirements for a VA loan with absolute clarity. We're not just scratching the surface. We are going deep into the 3 pillars of VA loan eligibility: your military service, your financial credit, and your income. We'll break down exactly what the VA requires, what the lenders are looking for, and how you can position yourself to take advantage of this incredible benefit you have earned. This is your definitive guide to answering the question, am I eligible for a VA mortgage? So let's start by killing the single biggest myth right now, the one that stops so many people from even trying a second time. The myth is that you can only use your VA loan benefit once. This is completely 100% false. You can use your VA loan benefit over and over and over again for the rest of your life. You can even have more than one VA loan at the same time in certain situations. The benefit you earn through your service does not expire. It is a lifelong key to homeownership. So if you've used it before and thought that was it, stick around because you might be able to use it again right now. With that out of the way, let's dive into the first and most fundamental pillar of eligibility, your service. This is the foundation. Without meeting these requirements, nothing else matters. The VA needs to verify that you served, and that you did so honorably. The good news is, the requirements are broader than most people think. This isn't just for combat veterans or those who retired after 20 years. The official proof you need is a document called the Certificate of Eligibility, or COE. Think of it as your golden ticket. It's the VA's official letter stating that you have met the minimum service requirements to apply for the loan. We'll talk more about how to get this piece of paper in a minute. Spoiler, it's way easier than you think. But first, let's figure out if you even qualify for one. Let's break down who is eligible, category by category. First, active duty service members. If you are currently serving in any branch of the U.S. military, Army, Navy, Air Force, Marines, Coast Guard, or Space Force, you are generally eligible after you've served for 90 continuous days of active duty. That's it. Just 3 months of continuous service, and you've unlocked the ability to buy a home with 0 down payment while you are still serving. This is a massive advantage for military families who are tired of throwing money away on rent every time they PCS. Next, and this is the largest group, are our veterans. For you, the eligibility rules depend on when you served. It's broken down by service eras. If you served during wartime periods like the Gulf War, which for VA purposes is a period that began in August of 1990 and is technically still ongoing, you generally need to have served for at least 90 consecutive days. So if you were deployed for Desert Storm or served in Iraq or Afghanistan, and have at least 90 days of active service, you likely meet the requirement. The same 90-day rule applies to veterans of the Vietnam War era, which the VA defines as running from November 1964 to May 1975, and the Korean War, from June 1950 to January 1955. For veterans who served during peacetime, specifically in the post-Vietnam era between 1975 and 1990, or before the Korean War from 1947 to 1950, the requirement is a bit longer. You typically need to have served for 181 continuous days of active duty. Now, for the vast majority of veterans who served after the early 90s but are now separated from the military, there's a different standard. You generally need to have completed 24 continuous months of active duty service. This covers most people who enlisted for a standard term and completed it. However, there's a critical exception. If you were discharged early for a service-connected disability, the time and service minimums may not apply to you. If you have a disability rating from the VA, you are almost certainly eligible regardless of how long you served. Okay, what about the National Guard and the reserves? This is another area filled with confusion. For years, it was much harder for Guard and Reserve members to qualify. But the rules have changed for the better. The standard requirement now is that you must have completed 6 years of honorable service in the selected Reserve or National Guard. After those 6 years, you earn the same VA home loan benefit as your active duty counterparts. But again, there's a huge exception. If you were called to active duty under Title 10 or Title 32 orders, the rules change. In that case, you only need to have served 90 cumulative days of active service, and at least 30 of those days must have been consecutive. This means a single deployment or mobilization could make you eligible years ahead of schedule. Finally, and this is so important, let's talk about surviving spouses. This powerful benefit can pass on. If you are the unremarried spouse of a service member who died in the line of duty, or as a result of a service-related disability, you are very likely eligible for a VA loan. There are also provisions for spouses of service members who are missing in action or being held as a prisoner of war. This is a sacred part of the VA's promise, to take care of the families of those who made the ultimate sacrifice. If this is your situation, you have absolutely earned this benefit. So, to recap the first pillar, eligibility is determined by your time and character of service. Whether it's 90 days on active duty, 6 years in the Guard, or meeting the criteria as a surviving spouse, there are many paths to that certificate of eligibility. And that COE is the key that unlocks the entire process. It's the document you or your lender will present that proves to the bank that the VA is willing to guarantee your loan. You can apply for it yourself online through the VA's portal, but here's a pro tip. Don't. The fastest and easiest way is to let your VA-savvy mortgage lender do it for you. They have a system that can often access the VA database and pull your COE in a matter of minutes. It's one of the first things they'll do. Now, having the right service record and that certificate of eligibility is step one. Gets you in the door. But it's only 1/3 of the equation. The next two pieces, credit and income, are where the banks get involved, and they have their own set of rules that can make or break your deal. The VA sets the minimum guidelines, but the lenders add their own requirements on top of that, and that's where things can get tricky. And that's exactly what we're going to demystify next. So let's pull back the curtain on this idea of lender requirements, or what the industry calls overlays. This is, without a doubt, one of the biggest reasons a veteran who is perfectly eligible for a VA loan gets told no. It's frustrating, it's confusing, and it makes people think the whole system is rigged against them. But it's not. You just have to understand the game. Imagine the VA loan program is like an exclusive nightclub. The Department of Veterans Affairs is the owner of the club. The owner sets one single, simple rule for entry. You have to be a veteran with entitlement. That's it. That's the VA's only rule to get in the door. But the owner doesn't work the door themselves. They hire bouncers. And those bouncers are the mortgage lenders. Now the bouncer has to follow the owner's main rule. They can't let in someone who isn't a veteran. But the bouncer, to protect the club and their own job, adds a few more rules. They might say, okay, you're a veteran, great. But you also need to follow our dress code. No sneakers. You also can't be causing a scene in the line. And we're only letting in a certain number of people tonight. Those extra rules, the dress code, the behavior check, those are lender overlays. They are extra requirements laid over the VA's base guidelines. The lender isn't trying to punish you. They're trying to manage their own risk. And this is the key detail everyone misses. The VA does not lend you the money. A private bank or mortgage company does. The VA simply provides a guarantee on a portion of that loan. If you default, the lender still takes a financial hit. So, to protect themselves from that loss, they add their own safety rules. And the number one overlay, the one that stops more veterans in their tracks than any other, is the credit score. If you read the official VA Lender's Handbook, it says in black and white that there is no minimum credit score required for a VA loan. Let me repeat that. The VA itself does not have a minimum FICO score. So why did you, or your buddy, or someone on a forum get told they needed a 620 or a 640 to qualify? Because that was the lender's rule. That was their overlay. Almost every single lender in the country has a minimum credit score requirement for a VA loan. For most, it hovers around a 620 FICO score. Some are higher at 640 or even 660. A few might go a little lower, maybe down to 600 or, in very rare cases, 580. They use this score as a quick snapshot of your financial reliability. It's an easy, quantifiable number they can use to filter applications. Let's imagine a real-world scenario. Let's call our veteran Sarah. Sarah just got out of the Navy after 6 years of honorable service. She's got a great new job, she's saved up some cash for closing costs, and she wants to buy a small condo. She checks her credit and it's a 615. Not perfect, but she's never missed a payment in her life. The low score is mostly due to a high balance on a credit card she used for moving expenses, which she's actively paying down. She walks into a big national bank, the same one her parents have used for 30 years. She applies for a VA loan. A few days later, she gets a denial letter. Reason: credit score below minimum requirement of 620. Sarah's crushed. She thinks, I guess I'm not eligible for a VA loan. My credit isn't good enough. But she's wrong. She's 100% eligible for the VA loan program. She is not eligible for that specific bank's version of the VA loan. That 5-point difference between her 615 and their 620 minimum was their bouncer telling her she was wearing the wrong shoes. It had nothing to do with the club owner, the VA. The story doesn't end there. Sarah talks to a fellow veteran who tells her to try a different lender, one that specializes in VA loans. She's skeptical, but she makes the call. The new loan officer listens to her whole story. He says, okay, our minimum score is 600, so you're fine there. And I see you've never had a late payment, which is a huge compensating factor. We can absolutely work with this. 2 months later, Sarah is moving into her new condo. Same veteran, same income, same credit score. The only thing that changed was the lender and their overlays. This happens thousands of times a day. The next major overlay is your debt-to-income ratio, or DTI. This is simply a percentage that shows how much of your monthly gross income goes towards paying your debts. Things like car payments, student loans, and credit card payments. Now, the VA is famously flexible on DTI. They are much more concerned with something called residual income. This is the amount of money you have left over each month after paying all your major expenses, including your new mortgage. The VA has a chart that says for your family size and your part of the country, you need to have a certain amount of cash left over. As long as you meet that residual income threshold, the VA is often okay with a higher DTI. They trust you to manage your own budget. Lenders, however, are not always so trusting. Many lenders impose a hard cap on DTI, often at 45%, 50%, or maybe 55% in some cases. They don't care if you have thousands of dollars in residual income left over. If their computer sees that your DTI is 1% over their limit, you get an automatic denial. Let's go back to Sarah. What if her credit score was a 680 but she had a big truck payment? Let's say her DTI was 52%. She could go to a lender with a strict 50% DTI overlay and get denied, even with a great credit score and tons of leftover income. But another lender might see that she has $2,000 in residual income every month, way more than the VA requires, and approve her loan without a second thought. They understand the spirit of the VA guideline, not just the black and white letter of their own overlay. This same principle applies to other areas too. Employment history is a big one. The VA understands that service members transition to civilian life. You might not have a 2-year history at your new job. The VA gets that. But many lenders have a rigid overlay requiring a 2-year history in the same line of work. No exceptions. A veteran-savvy lender knows how to document your military experience as work history and get you approved. It even applies to the property itself. The VA will guarantee a loan on a wide range of properties, including manufactured homes and certain condos. But many lenders have overlays that say, we don't do manufactured homes, or we only lend on condos from a very specific, pre-approved list. So you might find the perfect home, one the VA has no problem with, only to be told by your lender that they simply won't finance that type of property. It's not a VA rule, it's their rule. So what's the lesson here? The single most important decision you will make in the VA loan process is not which house you choose, but which lender you choose. Getting a no from one lender is not the end of the road. It's just data. It's one bouncer at one club telling you they have a different dress code. It doesn't mean you can't get into any club in town. It just means you need to find the one that's the right fit for you. You need to find a lender who not only participates in the VA loan program, but truly specializes in it and understands the unique financial lives of veterans. They have fewer, more flexible overlays, and they know how to look at your file as a whole person, not just a set of numbers. Finding that lender is your mission, because once you do, you've cleared the biggest and most confusing hurdle. You've proven you meet both the VA's requirements and a lender's requirements. But now, that lender is going to ask you to prove it. They need the one document that acts as your golden ticket for this entire process. It's the official proof from the VA that you have earned this benefit. Getting it can be incredibly simple or surprisingly complicated depending on your service history. That document is your Certificate of Eligibility, or COE, and we're about to break down exactly what it is and how to get your hands on it. Think of the Certificate of Eligibility, or COE, as the VA's official stamp of approval. It's a formal document that tells a mortgage lender one critical thing. You, the veteran or service member, have met the minimum service requirements to be considered for a VA loan. It's not a loan approval itself. We'll get to the lender's requirements later, but it's the non-negotiable first step. It's the key that unlocks the door to the entire process. Without a COE, a lender can't even begin to process your VA loan application. So, how do you get this all-important document? The good news is, for the vast majority of veterans, it's incredibly fast and simple. In fact, you might not have to do anything at all. The easiest and most common way to get your COE is to let your VA-approved lender do it for you. Lenders have access to a VA system called the WebLGY portal, which stands for Web Loan Guarantee. When you apply for a loan, your loan officer will ask for your Social Security number and a few other details. They'll plug this information into the system, and in many cases, an electronic COE is generated instantly. It's that easy. The VA's databases have gotten remarkably good over the years, especially for those who served more recently. So, if you separated from the military in the last 20 years, there's a very high chance your lender can pull your COE in a matter of seconds while you're on the phone with them. But what if you want to get it yourself? Maybe you're just starting your home buying research and aren't ready to talk to a lender yet. Or maybe you just like having your documents in order beforehand. That's a great idea, and you absolutely can get the COE on your own. The primary way to do this is online. You can log into your eBenefits portal or go directly through the va.gov website. You'll need to verify your identity, usually through a service like ID@me, which is a secure login system used by many government agencies. Once you're logged in, you'll navigate to the Housing Benefits section and find the option to request your Certificate of Eligibility. You'll answer a few questions about your service, and if your information is in the VA's automated system, you can often download a PDF of your COE right then and there. The third option is the old-school, tried-and-true method, applying by mail. This is by far the slowest route and should really only be used if you can't get your COE through a lender or online. To do this, you'll need to fill out VA Form 26 to 1880, which is the request for a Certificate of Eligibility. You'll mail this form, along with proof of your military service, to the VA Regional Loan Center that handles your state. You can find the correct address on the VA's website. Just be prepared to wait. While the online methods can be instant, the mail-in process can take several weeks. In a competitive housing market where speed is everything, waiting weeks for a piece of paper can be the difference between getting your dream home and losing it to another buyer. Now, this all sounds straightforward, but there's a critical piece of the puzzle we need to discuss: the proof. Whether you're getting the COE through a lender, online, or by mail, the VA needs to verify your service. If your records are already in their automated system, great. But if they're not, the system will kick back a message saying it needs more information. This is where having the right documents ready to go is absolutely essential. The specific document you need depends entirely on your status. Let's start with the most common group: veterans who have separated or retired from service. The single most important document for you is your DD Form 214. This is your certificate of release or discharge from active duty. But not just any copy will do. You need to provide the Member 4 copy. Why is that specific copy so important? Because the Member 4 copy contains critical information about your discharge, specifically the character of service. It will state whether your discharge was honorable, general, other than honorable, and so on. As we discussed in the last section, you need an honorable discharge or a qualifying equivalent to be eligible, and the DD 214 Member 4 is the primary way the VA verifies this. If you can't find your DD 214, don't panic. You can request a copy from the National Archives online. It's a process, but it's doable. Okay, but what if you're still serving on active duty? You don't have a DD 214 yet. In this case, you'll need a document called a Statement of Service. This isn't a standardized form. It's a letter or memorandum provided by your command. However, it must contain very specific information for the VA to accept it. The Statement of Service must be on official command letterhead and signed by your adjutant, personnel officer, or commander. It needs to clearly state your full name, social security number, and date of birth. It also must include your date of entry into service and the duration of any lost time. That is, any time you were away without leave or in confinement, as this time doesn't count toward your service requirement. Finally, it must include the name of the command providing the information. Getting this statement is usually a straightforward process through your unit's administrative office, but make sure it has all of those required elements, or the VA will reject it, causing delays. Now let's talk about members of the National Guard and Reserves. This is where it can get a bit more complex because eligibility can be based on either federal active duty service or on a total length of time served. If you were called to active federal service under Title 10 orders, for example, you were deployed to Iraq or Afghanistan, then you will have a DD-214 for that period of service, and you'll use that just like a regular active duty veteran. However, if you're qualifying based on having served 6 or more creditable years in the selected reserve or guard, you'll need different paperwork. Your key document will be your latest annual retirement points summary. This is often called an NGB Form 23 for the Army National Guard or an ARPC Form 606E for the Air Force Reserve, but the name can vary. Essentially, it's the official record showing your years of satisfactory service. You'll likely need to provide this point statement along with evidence of your honorable service. Finally, and this is incredibly important, let's talk about surviving spouses. The VA home loan benefit can extend to the unmarried surviving spouse of a veteran who died as a result of service-related causes or has a total service-connected disability rating. The process for a surviving spouse to get a COE is different, and it requires different documentation. First, you'll need to fill out a specific VA form, Form 26 to 1817, which is the request for determination of loan guarantee eligibility, unmarried surviving spouse. Along with this form, you'll typically need to provide the veteran's DD-214 if you have it to prove their service. You'll also need your marriage certificate to prove your relationship to the veteran. Most importantly, you will need the veteran's death certificate or a DD Form 1300, which is the report of casualty. This document should indicate that the veteran's death was in the line of duty or resulted from a service-connected disability. If you are already receiving dependency and indemnity compensation or DIC, you should also provide a copy of your VA award letter. This process is understandably more involved, but it is a powerful and earned benefit for those who have made the ultimate sacrifice. So, to recap this crucial step, the Certificate of Eligibility is your official proof of service for the VA loan program. The fastest way to get it is through a VA-approved lender. But whether it's you or the lender getting it, the VA system is only as good as the data it has. For many, it's an instant, automated process. But for others, especially those who served long ago, or those in the Guard or Reserves, you must be prepared to provide the correct documentation, your DD-214, Statement of Service, or Annual Points Summary. Having these documents ready before you even start house hunting can save you an immense amount of time and stress. Getting your COE is like getting the VA's green light. It confirms you've done your part through your military service. But that's only half the equation. Now you have to get the lender's green light. The VA sets the service guidelines, but the lender sets the financial ones. They're the ones actually giving you the money, and they have their own set of requirements you have to meet. This is where we move from your service history to your financial history. We're talking about credit scores, debt-to-income ratios, and proving you have a stable, reliable income. And the requirements might be very different than what you'd expect for a conventional loan. Let's dive straight into the biggest elephant in the room: your credit score. This is where so much misinformation lives. You've probably heard you need a 720, a 700, or some other impossibly high number to even think about a mortgage. For a conventional loan, that might be close to the truth. But for a VA loan? Forget everything you think you know. Here's the bombshell, the one fact that changes the entire game. The Department of Veterans Affairs does not, I repeat, does not have a minimum credit score requirement. Let that sink in for a second. The VA itself, the organization guaranteeing your loan, doesn't look at your application and say, "Sorry, a 610 credit score? Denied." They simply don't do it. Their guidelines are focused on the overall picture of your financial health, not one single 3-digit number. So why does everyone, from your buddy who just bought a house to half the articles on the internet, talk about a minimum credit score for VA loans? The answer lies with the lender. The bank, the credit union, the mortgage company, they're the ones actually lending you the money. The VA is just insuring it. And because the lenders are putting up the cash, they get to set their own internal rules. These are called lender overlays. Think of it like this: the VA sets the rules for the entire league. They say, here's what a player needs to be eligible to play in the game. But each individual team coach, the lender, gets to decide who they actually put on the field. The coach might say, "Yeah, the league says anyone can play, but on my team, I only want players who can run a 6-minute mile." That 6-minute mile is the lender overlay. It's an extra requirement on top of the VA's baseline. Most lenders today typically look for a credit score of around 620. Some are more flexible, going down to 600, 580, or in rare cases even lower. The key takeaway here is that if one lender tells you no because of your credit score, it doesn't mean you're disqualified from a VA loan. It just means you're not a fit for that specific lender's overlays. It's not a no from the VA, it's a no from that one coach. Your mission is to find the right coach for your team. So while your credit score does matter to the lender, it's not the ironclad gatekeeper many believe it is. The VA program was specifically designed to be more forgiving, to look at the veteran, not just the numbers. They understand that a few financial missteps in the past, maybe during a difficult deployment or a transition back to civilian life, don't define your ability to be a responsible homeowner today. Now let's move on to the next major piece of the financial puzzle: your debt-to-income ratio, or DTI. This one sounds intimidating, but the concept is actually very simple. It's a percentage that shows how much of your monthly gross income, that's your income before taxes, goes towards paying your monthly debts. Lenders use DTI to gauge your ability to handle a new mortgage payment on top of your existing financial obligations. To calculate it, you simply add up all your monthly debt payments, things like car loans, student loans, credit card minimum payments, and any other installment loans. You then divide that total by your gross monthly income. So, let's say your gross monthly income is $5,000. And let's say you have a $500 car payment and a $200 student loan payment. Your total monthly debt is $700. You divide 700 by 5,000, and you get 0.14. As a percentage, that's a DTI of 14%. For a conventional loan, lenders are often very strict about this number. But with a VA loan, once again we see that built-in flexibility. The VA has a general guideline, a sort of preferred DTI of 41% or less. If your DTI is under that 41% threshold, and you meet the other criteria, you're generally considered a safe bet. But what if you're over 41%? What if you have a couple of car payments or lingering student debt that pushes you to 45, 50, or even 55%? Is it game over? Absolutely not. And this is where we uncover the VA loan's true secret weapon. The one thing that truly separates it from every other mortgage product on the planet. It's a concept called residual income. Residual income is the master key that can unlock a VA loan approval, even when your DTI looks too high. While DTI is a simple ratio, residual income is a much more intelligent, more human way of looking at your finances. It's the amount of money you have left over each month after paying all your major expenses, including your new estimated mortgage payment, taxes, insurance, and your other debts. It answers the most important question: can you actually afford to live? Can you pay for gas, groceries, utilities, and childcare after all the bills are paid? The VA has a specific table that outlines the minimum amount of residual income a household needs to have. This amount varies based on your family size and the region of the country you live in. For example, a single veteran living in the Midwest will have a lower residual income requirement than a family of 5 living in a high-cost area like California or the Northeast. This is a complete game changer. Let's imagine 2 veterans, both with a 50% DTI. Veteran A has a high income, but also high debt and a large family in an expensive city. After all their bills are paid, they have very little money left over. They might not meet the residual income guideline. Now look at Veteran B. They have a more modest income, but they live debt-free aside from a small car payment, and they're in a lower-cost area. Even with a 50% DTI, after all their bills are paid, they might have a significant amount of cash left over, well above the VA's minimum requirement for their family size. A conventional lender would likely deny both of them based on the DTI ratio alone. But the VA lender, using the power of residual income, could look at Veteran B and say, yes, the ratio is high, but we can clearly see this person has more than enough money left over each month to live comfortably and handle this mortgage. This is a good loan. This is the VA looking at you as a whole person, not a spreadsheet. They understand that a simple ratio doesn't tell the full story of your financial life. Having strong residual income can overcome a less than perfect credit score and a higher than ideal DTI. It's the ultimate compensating factor. Finally, let's talk about the foundation of all of this, your income. The lender and the VA need to see that you have a stable, reliable income that is likely to continue for the foreseeable future. typically the next 3 years. This isn't just about how much you make, but also about the consistency and source of that income. For service members on active duty, this is straightforward. Your Leave and Earnings Statement, or LES, is the golden ticket. It clearly shows your pay, your allowances, and your time in service. Lenders love it because it's a clear, predictable income stream. For veterans who have transitioned out, it's about showing a stable work history, usually 2 years in the same job or field. A W-2 from a full-time job is the easiest to document. But what if your situation is different? Again, the VA is flexible. Are you self-employed? You can absolutely get a VA loan. You'll just need to provide more documentation, typically 2 years of tax returns, to show that your business provides a stable, reliable income. What about other sources of income? This is another area where the VA shines. VA disability compensation, retirement income, pensions, and Social Security can all be used to qualify for a VA loan. This income is considered incredibly stable and reliable. In fact, some of it can even be grossed up, meaning the lender can count it as a higher amount because it's non-taxable, which gives your qualifying power a serious boost. I once worked with a veteran who was 100% disabled, and his sole source of income was his disability compensation. He thought he could never own a home because he didn't have a job in the traditional sense. We showed him that not only did his income qualify, but because it was tax-free, it was treated as if it were 25% larger. He was approved and bought a home for his family, something he never thought possible. Whether it's from active duty pay, a civilian job, a small business you started, or your hard-earned benefits, the key is demonstrating that the income is consistent and likely to continue. It's the final pillar of your financial profile, proving to the lender that you have the means to make those mortgage payments month after month, year after year. So now that we've established the 3 pillars of borrower eligibility, your service, your credit, and your income, you might think you have the full picture. But there's a 4th critical component that is unique to the VA loan program. It's a cost that many first-time homebuyers don't see coming. And understanding it is absolutely essential before you even start looking at houses. We're talking about the VA funding fee. Now, don't let the word fee scare you off. This isn't some random administrative charge designed to line a lender's pockets. The VA funding fee is the very thing that keeps this incredible program alive and running for future generations of service members and veterans. Think of it as your way of paying it forward. It's a one-time fee paid directly to the Department of Veterans Affairs, and the money goes into a reserve fund. This fund is used to cover losses if a borrower, unfortunately, defaults on their loan. By having this safety net, the VA can provide that powerful guarantee to lenders, which is why they're willing to offer you a loan with 0 down payment and no monthly mortgage insurance. In short, the funding fee is the engine that powers the entire VA loan benefit. So, how much is it? This is where it gets specific, and you need to pay close attention, because the amount you pay can vary dramatically based on your personal circumstances. The fee is calculated as a percentage of your total loan amount. The 3 key factors that determine this percentage are your service type, whether it's your first time using the benefit, and the size of your down payment. Let's break it down with a clear example. Imagine you're buying a home for $400,000. For most active duty and veteran members using the benefit for the very first time with 0 down payment, the funding fee is currently 2.15%. So, on that $400,000 loan, your funding fee would be $8,600. Now, let's say this isn't your first rodeo. You used a VA loan years ago, sold that house, and now you're buying a new one. For this subsequent use, again with no money down, the fee jumps up to 3.3%. On that same $400,000 loan, the fee is now $13,200. That's a significant difference, and it's why it's so important to know whether you fall into the first-time use or subsequent use category. But here's where you have some control. The VA wants to encourage borrowers to have some skin in the game, even though it's not required. So, they incentivize a down payment by reducing your funding fee. Let's go back to our first-time user. If you put down at least 5%, in our example, that's $20,000 on a $400,000 home, your funding fee drops from 2.15% down to 1.5%. That takes your fee from $8,600 down to $6,000, saving you $2,600 right off the bat. If you can put down 10% or more, it drops even further to 1.25%. The same logic applies to subsequent users. A down payment will significantly lower that higher 3.3% fee. Now, for our National Guard and Reserve members, the numbers are slightly different, but the principle is the same. Your fees are just a fraction higher across the board. For a first-time use with no money down, your fee is 2.4% instead of 2.15%. It's a small distinction, but one to be aware of. So you've got these percentages, these numbers, and you're probably thinking, okay, that's a big chunk of change. How on earth do I pay it? Most veterans don't pay this fee out of pocket. The vast majority choose to roll it directly into their total loan amount. So, using our first example, instead of borrowing $400,000, you'd be borrowing $408,600. The fee becomes part of your mortgage, spread out over the 30-year term. Yes, this means you'll pay interest on it over time, and it will slightly increase your monthly payment, usually by about $40 to $50 a month on a loan of that size. But for most, this is a far more manageable option than coming up with thousands of extra dollars in cash at the closing table. Now, I have saved the most important piece of information about the funding fee for last. Because for a huge number of veterans, everything I just explained is completely irrelevant. There is a massive exception to this rule. A significant portion of VA borrowers are completely exempt from paying the funding fee. Not reduced, not deferred, 100% exempt. This is, without a doubt, one of the most powerful financial benefits available to our nation's veterans, and it can save you thousands upon thousands of dollars. So who qualifies for this exemption? The primary group is any veteran who is receiving VA compensation for a service-connected disability. If you have a disability rating from the VA, you do not pay the funding fee. Period. This also applies to veterans who would be entitled to receive disability compensation, but are receiving retirement pay or active duty pay instead. And critically, this benefit extends to the surviving spouses of veterans who died in service or from a service-connected disability. Let's put this into perspective. Remember that subsequent user buying a $400,000 home? Their funding fee was $13,200. If that veteran has even a 0% service-connected disability rating, that fee of $13,200 is completely waived. It vanishes. That is an enormous, immediate savings. This brings up a critical question we hear all the time. What if my disability claim is still pending with the VA when I close on my house? This is a fantastic question, and the VA has a process for it. If you close on your loan and pay the funding fee because your rating wasn't finalized, but your disability claim is later approved with an effective date that is before your closing date, you can apply for a refund of the entire funding fee. You heard that right. The VA will send you a check for the full amount you paid. This is why it's absolutely crucial to keep your lender in the loop about any pending disability claims. So to recap the funding fee, it's the mechanism that makes the VA loan possible for everyone. Its cost depends on your service, your down payment, and whether it's your first time. And most importantly, it's completely waived for veterans with a service-connected disability, which is a game-changing benefit. Understanding these four components, service, credit, income, and the funding fee, is the key to understanding your eligibility as a borrower. You now know what it takes for you to qualify for this incredible home loan benefit. But that's only half of the equation. The VA doesn't just approve the person, they also have to approve the property. The house itself has to meet a specific set of standards to ensure it's safe, sound, and sanitary. These are known as the VA's minimum property requirements, or MPRs. And failing to understand these can cause a dream home to turn into a dead deal right before you get to the finish line. So let's pull back the curtain on these minimum property requirements. What are they really? Think of it this way. The VA isn't just guaranteeing a loan for you, it's also making a bet on the house. They're co-signing on the biggest purchase of your life, and just like any smart co-signer, they want to make sure the asset they're backing is a good one. They want to ensure the home you're buying isn't a money pit in disguise. The MPRs are their way of kicking the tires, of protecting you, the veteran, from buying a property with serious, hidden problems and protecting themselves from backing a loan on a house that's falling apart. At its core, the VA boils everything down to three simple, powerful words: safe, sound, and sanitary. Every single MPR falls under one of these three umbrellas. Let's break down what that actually means when a VA appraiser walks through the front door of your potential dream home. First up, safe. This is about protecting you and your family from immediate harm. The appraiser is looking for anything that poses a physical hazard. This isn't about decorating taste, it's about life and safety. We're talking about things like proper handrails on all staircases. That charming old house with the steep basement stairs but no railing? That's a fail. A missing handrail is one of the most common and easiest to fix MPR issues. They'll look at the electrical system. Are there exposed wires hanging from the ceiling? Is the electrical panel an ancient, fire hazard fuse box instead of a modern breaker panel? The VA wants to see a system that can handle the demands of modern life without posing a fire risk. They'll check for functional smoke and carbon monoxide detectors, as required by local code. And here's a big one that catches so many people off guard, especially with older homes. Peeling paint. You might see a little flaking paint on a windowsill and think, no big deal, I can touch that up. But to a VA appraiser, that's a giant red flag. Why? Because if the house was built before 1978, that peeling paint is presumed to contain lead. Lead-based paint is a serious health hazard, especially for children. So any chipping, peeling, or flaking paint on both the interior and exterior of the home will be flagged and must be properly scraped, repainted, and sealed before the loan can close. The safety check also extends to the property itself. Is there a swimming pool? It must have a functional fence around it to prevent accidents. Is the property on a steep hill? The appraiser will check for signs of soil erosion or potential landslides. Safety is paramount. Next, let's talk about sound. This is all about the structural integrity of the home. The VA wants to know that the house has good bones. The appraiser is on a mission to find any evidence that the home is not structurally sound. They'll start from the top down. The roof is a huge focus. It must have remaining useful life. If the shingles are curled, cracked, and shedding granules, and it looks like one stiff breeze could send them flying, that's a problem. The appraiser doesn't have to be a roofer, but they can and will call for a professional roof inspection if they see signs of significant wear or active leaks. That little water stain on the ceiling of the guest's bedroom? That's not a cosmetic issue. That's evidence of a potential roof leak, which means the roof is not sound. Then they go to the bottom, the foundation. They will walk the perimeter and go into the crawlspace or basement, looking for major cracks, signs of water intrusion, or bowing walls. A little hairline crack in the concrete slab might be fine, but large horizontal cracks in a basement wall could indicate serious structural failure. That's a deal killer unless a structural engineer signs off on a very expensive repair. Soundness also covers everything in between. They'll look for evidence of termite damage or other wood-destroying insects. If there's any suspicion, they will require a professional pest inspection, often called a termite report. They'll check that the windows are intact and functional, not broken or painted shut. They're making sure the very shell of the house that's meant to protect you is in good working order. Finally, we have sanitary. This is about the home being a healthy and livable environment. It starts with the absolute basics of modern life. The property must have a continuous supply of safe drinking water. If it's on a public water system, great. If it has a private well, the VA will require a water test to ensure it's free from harmful bacteria and contaminants. They need to prove the water is safe to drink. The same goes for waste disposal. It needs a sanitary and working sewage system. If it's connected to the city sewer, that's usually straightforward. But if it's a septic system, the appraiser needs to be able to confirm it's in good working order. They'll look for any signs of failure, like soggy ground or foul odors around the tank or drain field. In some cases, they may require a full septic inspection and certification. Sanitary also means the home must have adequate living space. Every living area must have a source of heat, a way to be ventilated, and a source of natural light. You can't have a bedroom with no window. The mechanical systems, like the furnace and water heater, must be functional and safe. An old rusty furnace that looks like it's on its last legs will get flagged for a professional inspection. And of course, the property must be free of vermin and rot. The appraiser is looking for signs of active infestations of rats, mice, or anything else that would make the home unsanitary. Damp, moldy basements or crawl spaces are also a major red flag under the sanitary requirement. Now, it's critical to understand what the MPRs are not. The VA appraiser is not a home inspector. Their job is not to tell you that the 20-year-old dishwasher is inefficient or that the carpet is a hideous shade of green. Cosmetic issues are not MPR issues. Ugly countertops, dated light fixtures, worn-out flooring. None of that will stop a VA loan. The focus is strictly on that checklist: safe, sound, and sanitary. So what happens if the appraiser finds an issue? Is the deal dead? Not necessarily. This is a crucial point. The appraiser will complete their report, called a Notice of Value or NOV. If there are MPR issues, the NOV will be subject to certain repairs being completed. For example, value is $300,000, subject to scraping and painting the peeling exterior trim and installing a handrail on the basement stairs. This is where negotiations begin. Typically, the seller is responsible for paying for and completing these required repairs before the loan can close. After the work is done, the appraiser will come back out for a final inspection to verify it was completed correctly. If the seller refuses to do the repairs, the deal will likely fall through. You, as the buyer, are generally not allowed to pay for the repairs yourself before you own the home, because if the deal falls apart for some other reason, you've just sunk money into a house you don't own. Understanding these MPRs before you even start looking at houses is a superpower. As you walk through a potential home with your real estate agent, you can now look at it through the eyes of a VA appraiser. You can spot the missing handrails, the peeling paint, the water stains on the ceiling. You can identify potential deal breakers before you fall in love with a house and spend money on inspections. This knowledge transforms you from a hopeful buyer into an educated, empowered veteran, ready to find a home that not only captures your heart, but also meets the high standards set to protect you. You've got your service eligibility, you've found a house that passes the MPR test with flying colors, and you're ready to move forward. But there's one more critical piece of the puzzle, and it's arguably the most important one when it comes to the VA's final approval. It's the financial piece. The VA needs to know you can actually afford the mortgage payment not just today but for the long haul. And they have a unique way of measuring this that goes far beyond your credit score or your debt-to-income ratio. It's a secret weapon in the VA loan arsenal called residual income, and understanding how it works is the key that unlocks the entire process. Think of it this way. Your debt-to-income ratio, or DTI, is like looking at a map from 30,000 feet. It shows the major highways and cities of your financial life. It tells a lender what percentage of your gross monthly income is already spoken for by debt. But residual income? That's like having a GPS with live traffic updates, showing you every side street, every potential bottleneck, and exactly how much fuel you'll have left in the tank when you reach your destination. It's the ground-level truth of your budget. Specifically, residual income is the amount of money you have left over each month after you've paid all of your major, essential living expenses. And I mean all of them. We're not just talking about the debts that show up on your credit report. The VA's calculation is far more comprehensive. It starts with your gross monthly income, and then it starts subtracting. First, they take out all the taxes, federal, state, and local. Then they subtract Social Security and Medicare. Right away, this is a more realistic approach than DTI, which uses your pre-tax income. The VA wants to know what you actually bring home. Next, they subtract the big one, your future all-inclusive mortgage payment. That's the principal, interest, property taxes, and homeowner's insurance, often called PITI. They also subtract any homeowners association or condo fees. Then they subtract all your other monthly debt obligations, the car payment, the student loans, the minimum payments on your credit cards, everything from your credit report. But here is where the VA process truly separates itself from every other loan type on the planet. They also subtract estimates for two huge real-world expenses that conventional loans completely ignore: utilities and maintenance. That's right. The VA knows that owning a home costs more than just the mortgage payment. You have to pay for electricity, water, gas, and trash collection. Things will break and you'll need to fix them. So they use a standardized formula, typically based on the square footage of the home you're buying, to estimate these monthly costs and subtract them from your income as well. And finally, if you have recurring childcare costs, they subtract that too. What you're left with after all of that is paid is your residual income. It's your family's living money. It's the cash you have for groceries, gas, clothing, cell phone bills, car insurance, and maybe, just maybe, a pizza on a Friday night. It's the ultimate measure of your ability to not just afford the mortgage payment, but to actually live and thrive in your new home without financial stress. This isn't just some arbitrary bureaucratic hoop to jump through. This entire calculation is born from the VA's core mission: to help veterans achieve and, more importantly, sustain homeownership. The VA has one of the lowest foreclosure rates of any loan program in America, and residual income is the #1 reason why. They are fiercely protective of the veterans they serve. They would rather tell you no on a loan for a house that will stretch you too thin than say yes and watch you struggle and potentially lose that home a few years down the road. It's a shield, not a sword. So, how much residual income do you actually need? This is where it gets both specific and flexible. The VA establishes a minimum monthly residual income you must have, but this number isn't one size fits all. It's tailored to your specific life circumstances, based on two key factors: your family size and your geographic location. It makes perfect sense. A single person living alone needs less money for groceries and daily expenses than a married couple with 3 children. The VA accounts for this by increasing the minimum residual income requirement for each member of your household, including your spouse and children, even if your spouse isn't on the loan. And just as a family of 5 costs more than a family of 1, living in San Diego, California costs a whole lot more than living in Biloxi, Mississippi. To account for this, the VA divides the United States into 4 regions: the Northeast, the Midwest, the South, and the West. The minimum residual income requirements are highest in the Northeast and the West, and lower in the more affordable South and Midwest. Let's put this into practice with an example. Imagine a single veteran with no children buying a home in the South. Based on the VA's 2024 guidelines, their minimum required residual income might be around $490 per month. That means after paying taxes, their new mortgage, their car loan, and estimated utilities, they need to have at least $490 left over for everything else. Now let's take that same veteran and move them into a different scenario. Let's say they're now married with 2 children, and they're buying a home in the high-cost Northeast region. Suddenly, their minimum residual income requirement jumps to over $1,158 per month. The VA recognizes that their family and living expenses are significantly higher, and the guideline adjusts accordingly to ensure they can live comfortably. But here's the most important part of this entire discussion. What if you do the math and you come up a little short? What if the guideline for your family and region is $1,000, but your calculated residual income is only $920? Are you automatically denied? Absolutely not. This is where the VA loan shines and the human element of underwriting takes over. If your residual income is a bit low, but your overall financial picture is strong, an underwriter can approve your loan using what are called compensating factors. These are positive elements in your file that help offset the risk and demonstrate that you're still a reliable borrower. What counts as a compensating factor? There are many, but some of the most powerful ones include having a significant amount of cash saved up. If you have 6 months' worth of mortgage payments sitting in a savings account, that's a massive compensating factor. It shows you have a cushion for emergencies. Another one is excellent credit. If you have a long history of paying all your bills on time every time, it demonstrates a high degree of financial responsibility. Or perhaps you have very little consumer debt. You don't carry big balances on credit cards, which shows you live within your means. A history of stable, reliable employment is also a huge plus. If you've been at the same job for 5 years and have a history of receiving regular raises, that tells the underwriter your income is secure and likely to grow. In fact, that potential for future income growth can itself be a compensating factor. Even having a spouse with a stable income, who isn't a co-borrower on the loan, can be used as a compensating factor in some cases, because it contributes to the overall financial stability of the household. The underwriter looks at the whole story. They see you're not just a number on a page. They're trying to answer one fundamental question. Can this veteran and their family succeed in this home? The residual income calculation is the VA's most powerful tool for answering that question. It's a detailed, real-world stress test of your budget, designed to protect you. It ensures you have enough breathing room to handle the unexpected expenses that life always throws your way. It's the reason the VA home loan benefit is often called the most powerful mortgage option on the market. So, residual income is the VA's detailed, real-world affordability check. But it doesn't operate in a vacuum. It works hand-in-hand with that other more famous financial metric, the debt-to-income ratio. And while the VA is famously flexible on DTI, there's a critical threshold you absolutely need to know about, because crossing it triggers a whole different level of scrutiny. So let's talk about the debt-to-income ratio, or DTI. If residual income is the microscope, looking at the fine details of your monthly budget, DTI is the telescope, giving the lender a big-picture view of your overall financial obligations compared to your income. It's a simple percentage that answers one question. What portion of your gross monthly income is already spoken for by debt, including your new potential mortgage payment? Now, the VA loan is legendary for its flexibility on DTI. You'll hear stories online of people getting approved with DTI ratios of 50%, 55%, even close to 60%. And while those cases do exist, they are the exceptions, not the rule. They are the Hail Mary passes that get completed, but you can't build a game plan around them. For most applicants, there is a very real, very important guideline that acts as a tripwire. That critical threshold is 41%. Let's be crystal clear. 41% is not a hard stop. It is not a law written in stone. You can absolutely get a VA loan with a DTI higher than 41%. But the moment your file hits an underwriter's desk and that number ticks from 40.9 to 41, everything changes. The light on their dashboard turns from green to yellow. It signals to the lender that while this loan might still be perfectly safe, they need to slow down, look closer, and justify their decision to approve it. This is what we mean by a different level of scrutiny. A DTI under 41%, combined with meeting the residual income guidelines, is what the VA considers a safe harbor. It's a strong indicator that the veteran is in a solid financial position to handle the mortgage. If you're in that zone, the underwriting process is generally much smoother and faster. But if you're over 41%, the lender is now required by the VA to document what they call compensating factors. These are positive elements in your financial profile that help offset the perceived risk of a higher DTI. Think of it like this: your high DTI is a negative mark on your report card. Compensating factors are the extra credit projects you did that prove you're still a good student. The lender has to build a case for you, and they need ammunition to do it. So what are these powerful compensating factors? The first and most common is a significant amount of cash reserves. This means money left over in your bank account after you've paid all your closing costs. We're not talking about a few $100s. A strong compensating factor would be having 3 to 6 months worth of your total mortgage payment. That's principal, interest, taxes, and insurance, sitting in savings. This tells the lender that if you hit a rough patch, like a temporary job loss or an unexpected medical bill, you have a cushion. You won't immediately default on the loan. The more you have in savings, the stronger this factor becomes. Next is excellent credit. While the VA itself doesn't set a minimum credit score, lenders do. And if your DTI is high, a top-tier credit score becomes incredibly important. A score of, say, 740 or higher demonstrates a long history of managing debt responsibly. It tells the underwriter, yes, this person has a lot of monthly payments, but look at their track record. They have never missed one. It's a powerful testament to your financial discipline. Another huge one is what we call low payment shock. This is one of the most underrated but logical factors. Payment shock is the difference between what you're paying for housing now, your monthly rent, and what your new mortgage payment will be. If your rent is currently $1,800 a month, and your new mortgage payment is $1,900, your payment shock is very low. You've already proven for years that you can comfortably afford that housing expense. But if your rent is $1,800 and your new mortgage is $2,800, that's a massive jump. The lender gets nervous because you have no history of successfully managing such a large monthly payment. A payment shock of 5% or less is considered a very strong compensating factor. Then there's your employment history. A long, stable career in the same field or with the same company is a major plus. It suggests future income stability. If you've been a nurse for 10 years and have consistently received raises, that's much more comforting to a lender than if you've had 5 different jobs in 3 different industries over the past 2 years. Let's put this into a real-world scenario. Meet veteran A, let's call her Sarah. Sarah is a staff sergeant with a gross monthly income of $6,000. She has a car payment and some student loans, and with her new potential mortgage, her total monthly debts would be $2,880. Her DTI comes out to 48%, well over the 41% guideline. On paper, that looks risky, but the underwriter digs deeper. They see Sarah has a 760 credit score. She has $15,000 in her savings account, which is about 6 months of her future mortgage payment. She's been in the military for 8 years, showing incredible job stability. And her new mortgage is only $200 more than the rent she's been paying on time for the last 3 years. Sarah's file is a textbook example of how strong compensating factors can overcome a high DTI. She is almost certain to be approved. Now consider veteran B, let's call him Mike. Mike has the exact same income and the exact same 48% DTI. But his story is different. His credit score is 640. He has only $1,000 in savings after closing costs. He just started a new civilian job 6 months ago after leaving the service. And his new mortgage payment will be $900 more than his current rent. Mike's file has a high DTI with no compensating factors to offset it. In fact, his profile has additional layers of risk. Mike's loan is very likely to be denied. The underwriter simply can't build a compelling case that he can handle that debt load long-term. It's not about the DTI number in a vacuum. It's about the story your entire financial profile tells. So, how do you even calculate this number for yourself? It's actually pretty simple. First, add up all of your minimum monthly debt payments. This includes your car loan, student loans, personal loans, and the minimum payments on your credit cards. Don't include things like utilities, cell phone bills, or car insurance. We're only talking about loans and lines of credit. Second, get an estimate for your future total monthly mortgage payment. This is key. Don't just look at a mortgage calculator online that only shows principal and interest. You need to include estimates for property taxes, homeowner's insurance, and if applicable, HOA fees. A good loan officer can give you a very accurate estimate for your area. Third, add your current debts and your future housing payment together. This is your total monthly debt obligation. Finally, divide that total number by your gross monthly income. That's your income before any taxes or deductions are taken out. Then multiply the result by 100 to get your DTI percentage. For example, let's say your gross monthly income is $7,000. Your car payment is $400, student loans are $200, and credit card minimums are $100. That's $700 in current debt. Your estimated new mortgage payment is $2,500. So your total monthly obligations would be $700 plus $2,500, which equals $3,200. Now you take that $3,200 and divide it by your $7,000 gross income. That gives you 0.457, multiply by 100, and your DTI is 45.7%. Seeing that number, you now know you're over the 41% guideline. You're in compensating factor territory. You can look at your own profile and ask, do I have great credit? Do I have significant savings? Is my job stable? This knowledge is power. It allows you to either work on improving those factors before you apply, or to find a house that's a little less expensive to bring that DTI number down. Remember, the goal of the VA and the lender isn't to deny you. The goal is to ensure you're being placed in a home you can afford for the long haul, to prevent foreclosure, and to protect the integrity of this incredible benefit earned by your service. The 41% rule and the requirement for compensating factors isn't a gate designed to keep you out. It's a guardrail designed to keep you safe on the path to homeownership. Now, assuming your income checks out, your DTI is in a good place, and you've got your certificate of eligibility in hand, you're almost there. But there's one final financial piece of the puzzle that every veteran using this loan needs to understand. It's a cost that's unique to the VA loan program, a fee that can range from literally $0 to thousands, and it's all based on your service history and whether you've used the loan before. This isn't a lender fee or a closing cost in the traditional sense. It's called the VA funding fee, and knowing whether you're required to pay it, or more importantly if you're exempt, is absolutely critical. Why and whether you've used the loan before. This isn't a lender fee or a closing cost in the traditional sense. It's called the VA funding fee, and knowing whether you're required to pay it, or more importantly if you're exempt, is absolutely critical. So what exactly is this fee? Think of it as the engine that keeps the entire VA loan program running for future generations of veterans. Because the VA guarantees a portion of your loan, it allows lenders to offer incredible terms like zero down payment and no monthly mortgage insurance, or PMI. That PMI alone can save you hundreds of dollars every single month. The funding fee is a one-time payment that helps offset the potential risk to the government, ensuring the program remains solvent and available. It's a small price for an enormous benefit. Now, the first question most people ask is, how do I pay it? You have two primary options. The most common method by far is to roll it directly into your total loan amount. So, if you're buying a home for $300,000 and your funding fee is $6,000, your total loan amount would become $306,000. You don't have to come up with that cash out of pocket. The other option is to pay it in cash at closing, alongside your other closing costs. For those who can afford it, this means you won't be paying interest on the fee over the life of the loan, but for most people, financing it is the more practical choice. Alright, let's get into the numbers because this is where it gets specific. The percentage you'll pay for the funding fee is not a one-size-fits-all deal. It depends on 4 key factors: your branch of service, the size of your down payment, whether this is your first time using a VA loan, and the type of loan you're getting. Let's start with the most common scenario: a purchase loan for an active duty service member, a veteran, or a National Guard or Reserve member with active duty service. If this is your very first time using your VA loan benefit and you're putting zero down, which is what most people do, your funding fee will be 2.15% of the loan amount. So, on a $400,000 home, that's $8,600. But watch what happens when you make a down payment. If you put down at least 5% but less than 10%, that fee drops to 1.5%. On that same $400,000 home, your fee is now just $6,000. You save $2,600 just by putting some skin in the game. If you can put down 10% or more, the fee drops even further to just 1.25%. Now, what if this isn't your first rodeo? What if you're a veteran who has used the VA loan before, and you're buying another home? The VA calls this a subsequent use loan. In this case, the numbers are a bit higher. For a subsequent use loan with zero down payment, the funding fee jumps to 3.3%. Yes, that's a significant increase. On that same $400,000 loan, your fee is now $13,200. This is the VA's way of balancing the risk for repeat users of the program. However, just like with the first-time use, making a down payment can dramatically reduce this fee. Put down 5% and it drops back to 1.5%. Put down 10% and it's 1.25%, the same as a first-time user. For our National Guard and Reserve members who don't have prior active duty service, the numbers are slightly different, but only for the first-time, zero down payment scenario. For you, that fee is 2.4%. But for every other scenario, making a down payment or subsequent use, the fee percentages are exactly the same as for regular military. This fee also applies to refinancing. For a VA cash-out refinance, the fee structure is very similar to a purchase loan. But for an interest rate reduction refinance loan, also known as an IRRL or a VA streamline, the fee is a simple, flat 0.5% for everyone, regardless of your service history or prior loan usage. I know that was a lot of numbers, but understanding them is the key to making a smart financial decision. But what if I told you there's a way to completely waive this fee? A way to potentially save thousands, even tens of thousands of dollars, right at the start of your loan, no matter how many times you use the benefit? This is, without a doubt, the single most important exception in the entire VA loan process, and a surprising number of veterans who qualify don't even know it. You are completely exempt from paying the VA funding fee if you meet certain criteria. The most common exemption is for veterans who are receiving VA compensation for a service-connected disability. It doesn't matter what your disability rating is, whether it's 10% or 100%. If you are receiving that monthly compensation, you do not pay the funding fee. Period. Another category for exemption is for veterans who are entitled to receive disability compensation but are not, because they are receiving retirement pay or active duty pay instead. This is a crucial distinction. If the VA has determined you have a service-connected disability that would qualify you for compensation, you are exempt, even if you've chosen to receive a different type of payment. The exemption also extends to surviving spouses of veterans who died in service or from a service-connected disability, provided they are receiving dependency and indemnity compensation, or DIC. And finally, a more recent and incredibly important addition. Active duty service members who provide evidence that they have been awarded the Purple Heart are also exempt from the funding fee. So how does the VA and your lender know if you're exempt? It all comes back to your certificate of eligibility, or your COE. In most cases, if you qualify for an exemption, your COE will clearly state exempt in the funding fee box. When your lender pulls your COE, they'll see it right away, and the fee will be removed from your loan estimate. But what if you know you should be exempt, and your COE doesn't say so? Don't panic. This can happen if your disability rating was awarded after your COE was initially issued. Your first step is to gather your documentation. The most important document is your VA Disability Award letter. You'll provide this to your lender, who can then work with the VA to get your COE updated, or provide the necessary proof to waive the fee. Now for the million-dollar question I get all the time. What if your disability claim is still pending with the VA while you're trying to buy a house? This is a nail-biting situation for so many veterans. Here's how it works. To be exempt, your disability award must have an effective date that is before your loan closing date. If your claim is approved and the effective date is, say, May 1st, and you close on your house on May 15th, you are exempt. You will not have to pay the funding fee. But what if you close on May 15th, and your claim is approved a month later, but the effective date is retroactive to May 1st or earlier? You've already paid the funding fee because at the time of closing, you weren't officially exempt. Is that money gone forever? Absolutely not. And this is a life-changing piece of information. You can apply for a full refund of the VA funding fee you paid. You would work with your lender or directly with the VA's regional loan center to submit the paperwork, including your closing documents and your disability award letter. The VA will verify the dates, and if you qualify, they will mail you a check for the full amount of the funding fee you paid. If you rolled the fee into your loan, You can use that refund check to make a lump sum payment directly to your loan principal, effectively erasing that borrowed amount. This is your money and you are entitled to get it back. The VA funding fee is a fundamental part of the program, but knowing the rules, especially the exemption and refund rules, is what separates a good home buying experience from a great one. It's about ensuring you receive every single benefit you have earned through your service. And armed with this knowledge, we're now ready to tackle the final hurdles that stand between you and the keys to your new home. While the VA sets the guidelines for the loan guarantee, it's the private lenders who actually give you the money, and they have their own set of requirements you have to meet specifically when it comes to your credit and your income. Let's talk about that credit score first. This is probably the number one point of confusion. You'll hear people say, the VA loan has no minimum credit score requirement. And technically, they are absolutely right. The Department of Veterans Affairs itself does not set a credit score floor. They don't look at your application and say, sorry, a 580 isn't good enough. But remember, the VA isn't the one lending you hundreds of thousands of dollars. The bank is. And you better believe the bank has rules. Private lenders are taking on the risk, even with the VA's guarantee. So they use your credit score as a quick snapshot of your financial reliability. It's their way of gauging how likely you are to pay your mortgage on time every time. While there's no official number set in stone across the industry, you'll find that most VA-approved lenders are looking for a minimum credit score of around 620. Some might go a little lower, some might want a little higher, but 620 is a very common benchmark. If your score is below that, it doesn't mean it's impossible, but it does mean your options will be more limited, and you'll need to be stronger in other areas like having more cash reserves. The key takeaway is this: the VA gives you the ticket to the dance, but the lender is the one who decides if they want to dance with you, and your credit score is a huge part of that decision. Now, once the lender sees a credit score they're comfortable with, they immediately pivot to your income. They need to know you have a stable, reliable, and sufficient stream of money coming in to handle the mortgage payment. But they don't just look at your salary. They look at your salary in relation to your debt. This is where we get into a critical metric called the debt-to-income ratio, or DTI. Your DTI is a simple percentage. It's all of your monthly debt payments, things like car loans, student loans, credit card minimum payments, plus your proposed new mortgage payment, all divided by your gross monthly income, which is your income before taxes. So, if all your debts plus the new mortgage add up to $2,000 a month, and you make $5,000 a month before taxes, your DTI is 40%. The VA has a guideline here. They generally prefer to see a DTI of 41% or less. Now, hold on, before you panic and think you're out of the running, that 41% is a guideline, not a hard and fast rule. This is one of the most powerful and misunderstood features of the VA loan. Many other loan types, like conventional loans, have very rigid DTI caps. If you're $1 over, you're denied. End of story. But the VA loan is different. It's more flexible. It's possible to get approved with a DTI of 50%, 55%, or in some rare cases, even higher. How? Through something called compensating factors. These are positive elements in your financial profile that help offset the risk of a higher DTI. Think of it like a balancing scale. A high DTI puts weight on the risk side, but a compensating factor adds weight to the strength side to balance it out. What are these factors? A stellar credit score way above the 620 minimum. A significant amount of cash left in the bank after closing, what lenders call reserves. A long stable job history, or having a substantial down payment, even though one isn't required. If you can show the lender these strengths, they can often justify approving you even if you exceed that 41% guideline. But this flexibility leads us to the VA's real secret weapon when it comes to income qualification, and it's something most other loans don't even consider: residual income. Residual income is the single most important calculation in VA loan approval, more important than DTI. So what is it? It's the amount of money you have left over each month after you've paid all your major expenses. This includes your new mortgage payment, property taxes, insurance, all your other debts from the DTI calculation, estimated utility costs, and even a maintenance figure for the home. The VA even has a specific line item for federal and state taxes based on your income. They subtract all of that from your gross monthly income, and what's left is your residual income. It's your family's living money. It's the cash you have for groceries, gas, clothing, and everything else life throws at you. The VA believes that as long as you have enough of this leftover money, you'll be able to weather small financial storms without missing a mortgage payment. They have a chart that specifies the minimum amount of residual income your family needs to have, and it's based on your family size and the region of the country you live in. For example, a family of 4 living in the Midwest might need about $1,000 a month in residual income, while the same family in the more expensive Northeast might need over $1,200. This is why the VA loan is so powerful. You could have a DTI of 50%, which would get you an instant denial on many other loan programs. But if you can show the VA underwriter that you still meet the residual income requirement for your family size and location, you still have a very strong chance of getting approved. It's a common sense approach. The VA cares less about rigid percentages and more about the real-world answer to a simple question. Can this veteran actually afford to live in this house? Okay, so you've proven your service with your certificate of eligibility. You've passed the lender's credit check. You've navigated the DTI guideline, and most importantly, you've cleared the residual income threshold. You're in the clear, right? Almost. There's one final piece of the puzzle, and it has nothing to do with you. It has to do with the house itself. The VA isn't just protecting the lender, it's protecting you, the veteran. They want to ensure that the home you're buying is a good investment, and more importantly, that it's safe, sound, and sanitary. To do this, they require a special VA appraisal. This isn't just about determining the home's value. The VA appraiser also performs a basic property inspection to make sure the home meets what are called minimum property requirements, or MPRs. Think of MPRs as a basic safety and livability checklist. The house must have a roof that doesn't leak and has remaining useful life. It needs adequate heating and cooling systems. The electrical and plumbing systems must be in good working order. There can't be any broken windows or significant wood rot. A big one is any evidence of termites or other wood-destroying insects. And in homes built before 1978, there can be no chipping or peeling lead-based paint. If the appraiser finds an issue, say a leaky faucet, a broken step on the porch, or some peeling paint on a windowsill, they will note it on the appraisal report. And here's the crucial part. That issue must be fixed before the loan can close. This can sometimes be a point of negotiation. Who pays for the repair? You or the seller? But the bottom line is, the VA will not guarantee a loan on a property that doesn't meet their minimum standards for health and safety. It might seem like a hassle at the time, but it's a layer of protection designed to keep you from buying a money pit. So there you have it. The complete roadmap to VA loan eligibility. It starts with your honorable service, the foundation of this entire benefit. Then, you prove that service by getting your certificate of eligibility. From there, you enter the lender's world, where you need to demonstrate a satisfactory credit history and prove you have stable, reliable income that can handle the mortgage payment, focusing not just on DTI but on that all-important residual income. And finally, the house itself must pass the test, meeting the VA's minimum property requirements to ensure it's a safe and sound place for you and your family. It might seem like a lot of steps, but each one is a checkpoint on the path to homeownership. This isn't just any loan program. It's an earned benefit. It's a thank you from a grateful nation. It's a tool designed to give you, our veterans and service members, a tangible piece of the American dream you fought to defend. If you think you meet these requirements, your very next step should be to talk to a loan officer who truly specializes in VA loans. They live and breathe these guidelines every single day and can guide you through the process, from getting your COE to getting the keys to your new front door. You've served our country. Now it's time to let this incredible benefit serve you.